you actually did some analysis of how these flows may be impacting different factor strategies. Any major takeaways from that?
Yeah, and again, I think what I really want to stress here is my conviction in these ideas varies. I'm trying to do my best to not tell people where my conviction lies. But I think it's fun to sort of think about how these things play through. When you think about this narrative of moving from active to passive, again, a lot of these active strategies that are underperforming are underweight these mega cap growth names. And so that capitulation is going to move flow pressure towards buying up those mega cap growth names. And so it's not a surprise that based on that narrative, size and value, and even things like quality and low vol have underperformed to a certain degree because most of them are net underweight those mega cap names. It's just been growth and to a certain extent momentum that's been able to keep up. And so what you would expect is as this flow continues, those factors would continue to underperform and momentum would outperform. And that is to a large degree, at least for naive factors, what you have seen over the last decade. As you start to sort of work with more, I don't want to call them sophisticated or complex, but just more perhaps thoughtful craftsmanship factor implementations where value isn't just a naive price to book sort. It's a composite of signals, and you're industry neutral and factor neutral. Some of those have continued to hang on, but you've certainly seen a capitulation in recent years as it seems like that passive adoption has accelerated.
Yeah, I mean, you can certainly look back on factor performance over the last decade or so, and there's definitely a difference in character in terms of many factor strategies relative to what we observed in prior decades. And, certainly you and I have talked about this, and it could just be that many of these so-called factor approaches were data mined to begin with, Well,
I really
like some of them are, but I don't think you need to make the assertion that all of them are if you also are open-minded to the view that just the market structure has changed in the last decade in a way that is counterproductive for many of these factor strategy constructions.
Right, both from a microstructure perspective, but also reflexively as more and more people adopt them. Right, I really like your framework that you sent me the other day, and I don't know whether you're comfortable sharing it. Sort of this adoption framework idea of smart beta and pre-publication versus post-publication. I'd love for you to share that because I think it sort of plays into this, and these ideas of reflexivity in the market, I think, is largely underappreciated.
Yeah. Well, let's reserve that for another chat. But I definitely think there's a lot of meat there too. But yeah, I just think it is neat, and I know that in chatting with a lot of smart beta and factor investors, there's a lot of frustration, right? Yeah. I mean, any attempt to diversify away from cap weighting, with the possible exception of low vol, which has really lagged certainly in this recent thrust, which is to be expected in any given 3 or 6 month period. Any of these any active strategy would be expected to deviate. But if you look across the spectrum of smart beta strategies, it has been a very, very difficult decade.
And I think what's really hard is it's tough to determine, well, is this sort of just random noise, right? We see in all the old factor data, it certainly went through cycles where things didn't work. Is this an issue of too much adoption, right? No strategy can work with an unlimited amount of dollars. There is ultimately an issue there. Is this a change in market microstructure? Is this just poor implementation? I mean, you have published a tremendous amount on, well, if you have a specific model that you use, there's huge idiosyncratic model risk. Is it the stuff that I published about just timing luck risk that's unfolding? Exactly. I mean, there's just all sorts of stuff that makes it so hard to disentangle which narrative is reality, which I think is probably a feature of markets, not a bug. It's what keeps people operating in them. But I think to a certain degree, when you start to think of this world as a supply and demand versus, hey, the value premium just exists, right? And it is a thing. If you start thinking of the world of what's happening from a supply and demand perspective, you start to go, oh, it sort of makes sense why value would stop working if everyone moved from active value to indexed value, and in between rebalance periods, everything's a momentum-based flow.
Yeah, absolutely right. Yeah, and I mean, look, what is the source of these premia, right? The source of the premia is that there are investor cohorts that are that have preferences to not own securities with certain characteristics, either because for values reasons or for just different dimensions of risk, right? The not wanting to deviate too far from a benchmark, not wanting to take on leverage. There's a variety of different dimensions of risk that investors can perceive, and which would cause them to misprice securities relative to investors that are purely profit-seeking in a mean variance framework, right? So if you've got a certain amount of dollars based on investors that are mispricing securities for these reasons, then if you deploy an equal amount of dollars to arbitrage those mispricings, that is going to neutralize that effect, right? That edge or premia is going to go away. And if you get twice as many dollars that are chasing into stocks with certain characteristics, then that mispricing, the sign of that mispricing is now going to flip. And so a premium which previously had positive expectancy now may actually have negative expectancy. So, there's absolutely a very interesting rabbit hole to drive into there for another conversation.